I want to share an idea with you that I haven't read or learned from anyone specifically, but instead comes from my own observations. So I apologize in advance if it's a little rough around the edges. I want you to imagine that you're sitting on your living room couch, and you've got a red ball in your hand. You're about to throw the ball up into the air, and on its way down, you're going to let it bounce. If we're thinking about how high and how low the ball can go, we can use your living room floor and ceiling as the lower and upper limits. As you're holding out the ball in front of you, let's say near shoulder height, we can imagine the potential distance in each direction that the ball can go. The upward potential is represented by the green line, and the downward potential by the red line. We'll use this position right now as our zero, or our baseline. Once we throw the ball up, it begins getting closer and closer to the ceiling. We can see that as it gets higher, its upward potential gets smaller and smaller. At the same time, its downward potential is getting larger and larger. As the ball gives into the effects of gravity and begins falling downward, we can see the potential directions even out, and we get back to where we started. Instead of catching the ball, if we let it drop, we see that as the downward potential decreases, the upward potential grows accordingly. The total potential remains the same at all times. The only thing that changes is the direction the potential is allocated towards. The higher the ball gets, the less room remains for it to continue to move in an upward direction, meaning that more potential gathers in the downward direction, and the opposite is true. Essentially, the more the ball moves in one direction, the more potential it has to move in the opposite direction. If all that makes sense so far, let's look at a real-life example: mortgage rates. Here's a chart showing the 5-year fixed mortgage rate in Canada from 2006 to 2025. We can use the historical range of data on this chart to get a sense of what has been normal, and set our imaginary upper and lower limits. We can then draw our potential direction lines. Just like the thought experiment with the ball, the higher interest rates are, the more downward potential they have, and vice versa. This might seem super straightforward and obvious, but the reality is that it isn't. You can easily find a lot of stories online of how people who took variable mortgage rates during the all-time lows of 2020 and 2021 saw their payments soar as interest rates jumped. Yet looking at this chart, it's obvious that variable interest rates were the absolute worst option at that time. What makes variable interest rates attractive is the fact that you can get a lower interest rate and pay less interest overall if rates drop. You are assuming a bit of risk because rates could also increase, but it's a calculated decision. You really have to consider where interest rates are, what market sentiment is, and how likely something is to happen. We can never predict the future or know for sure what will happen, but if we use this chart as a scale of, let's say, 1% to 7.5%, when mortgage rates are about 1.5%, there's very little room for them to continue to drop, and enormous potential for rates to increase. Taking a variable mortgage rate here basically guaranteed that you'll have a higher interest rate in the near future. Even if we didn't see the historical rate increases that we did, they had significantly more potential to increase than they did to decrease, just based on where they were historically. If we understand what has been normal and where things are in comparison, although we can't guarantee our thoughts, we can have an idea of what might happen next. If our red ball is near the ceiling, it has more potential to come down than continue upward. If mortgage rates are at historic lows, they have more potential to increase than continue to decrease. We can use this same train of thought and apply it to investing. A very simple version would look like this. At any given time, the market has potential to either increase or decrease in value. If we zoom out to take a longer term look, maybe it looks something like this. We see our expected ups and downs, with more good than bad, and based on historical data, we establish an imaginary range of what we can expect to happen over a long period of time. Again, nothing guaranteed about it, but we can use what has been normal to suggest what could be normal moving forward. What we want to avoid is situations that look like this, when a company or asset significantly jumps outside of what could be considered normal. When this happens, it takes all expectations off of the table. When something stops being normal, we can't continue to treat it as normal. The dangerous thing about these bubbles is we often don't hear about them until it's well outside of the range of what could be considered normal. I like to imagine this point in time as a red ball compressing against the ceiling. It has defied our normal rules, with its center point continuing to go up. All the ball is doing now is essentially creating a spring within itself, and it'll soon be in a prime position to come down quicker than ever. This is exactly what we've seen with bubbles throughout history: unsustainable increase in value, and then a sharp drop back to reality. With market-wide bubbles, as long as we're diversified investors, our portfolios will survive, and will be first in line for the next wave of growth years, exactly where we want to be. It's when we're looking at individual companies, when we're taking big risks, that can really lead us into trouble. Here's the next illustration we'll spend some time with, and it's pretty simple. We have 4 main components to it: the market, an investor's sense of confidence, positive movement certainty, and a reasonable value zone. At any point, markets can be considered fair value within blue shade, overvalued above blue shade, or undervalued below blue shade. An undervalued market is like it being on sale, while an overvalued market is like paying a premium. Markets naturally fluctuate between these different zones. They always have and always will. When markets move up and become overvalued, at a point prices stop making sense. The price becomes less certain as it becomes more unpredictable. But at the same time, investors can feel a misguiding sense of confidence that the stock is unstoppable and going to the moon. In the opposite direction, as markets move down, prices become more stable, even falling into the range of being on sale. Even though things are becoming clear and more certain, investors' confidence falls along with the price, until investors have no interest in investing. It's an inverse relationship, and like many things with investing, a thing where a gut instinct or intuition can lead us astray. We often think that a falling market means uncertainty, but I would argue that a falling market provides clarity moving forward. It's a correction back to reasonable pricing and an opportunity to go back in time in the markets to buy at lower prices. We often view overvalued markets or stocks with unwarranted certainty, when they are actually at their most uncertain. Understanding the relationship between markets and uncertainty is important, because in a lot of cases our intuition is backwards. Even if we are just able to align uncertainty with hot stocks, that in itself could save us a lot of future anxiety and FOMO. The law of averages suggests that future events will balance out deviations from past events. In the short term, we may experience things that are either better or worse than their long-time average. But with enough time and consistency, those deviations will balance each other out. This is something that we accept in our day-to-day lives, even with some seriousness. We may believe that our bad luck is due to end, with no other reason than having a bit more of it than usual. Or after a bit of luck, we may decide to quit while we're ahead, knowing that the good times don't last forever. In sports, we see hot streaks and cold slumps all of the time. Teams and players are always over or underperforming compared to their long-term average. That is a key point to understand. Almost nothing progresses consistently at its long-term average pace. It's always over or under. A team may average a 60% win percentage over a season, but they can't win 60% of each game. Or a player may score 0.5 goals per game over a season, but they can't score half a goal in any single game. In his first ever NHL game, Austin Matthews scored 4 goals, making it one of the best NHL debuts ever. But even the most diehard Leafs fan couldn't tell you with a straight face that he would score 4 goals in every single game. Over the remaining 81 games of his rookie season, he would score 36 goals, for a total of 40. Over the season, he averaged 0.49 goals per game. But if we exclude his first game, he scored 0.44 goals per game. Because of his hot start, he actually underperformed his average for the rest of the season. When a team or a player over or underperforms in the short term, it's expected that the opposite will happen to revert to an average. You could even argue that the hotter the streak, the colder the return to the average will be. And that the more someone deviates from the average, the more likely they are to return to it. Scoring a lot of goals or making a lot of baskets in a short period of time almost guarantees a slump on the other end. In life and in sports, it's easy to see the law of averages at work. The more something goes in one direction, the more we expect it to go in the other direction. When it comes to investing, though, we change our thinking. We see a stock going up and state that instead of it naturally reverting back to its average, we believe that it will continue to increase in value forever. Something that's completely irrational and goes against every real-life example that we can lean on. Investing can be very complex, but at its core, it's made up of simple concepts. Instead of believing that investing defines the rules that tie together the rest of our world, we have to understand that those individual concepts operate in the same way that the rest of the world does. It's the idea of mental models, or finding a simplified explanation for how something works. The best part about mental models is once you understand concepts, you'll find that you can apply them to, seemingly, unrelated situations. They create a better general understanding for how everything works. When it comes to the law of averages, markets may have more data and a longer history of reverting to the average than anything else. It might actually have the strongest evidence supporting this. There's not really anything else that I can think of in my day-to-day life with 100+ years of history. Having a clear understanding of how everything works allows us to think about things more logically and less emotionally. It puts us in a position to make better long-term decisions. When we're able to make connections between things we don't fully understand and things that we do, like interest rates and throwing a ball in our living room, it can help make complex ideas simple. Any idea, regardless of its complexity, can be broken down into things that we can all understand. And once we do understand it, what to do and how to behave becomes crystal clear.